Hey, everybody, it's John Bice with eXp Real Estate and the Florida for Boomers Network. Today, I wanted to talk with my favorite mortgage person, Mike Tulia. I know absolutely nothing about mortgages. I know just enough to be dangerous. So when I have a question, I call Mike, and everybody is talking about waiting for interest rates to go down. What are interest rates going to do? So I wanted to ask Mike, get firsthand information. He is by far the smartest mortgage person I've ever dealt with because he stays on top of it. He knows what's happening, gives classes about what to expect coming up in the future. So Mike, thank you for being here.
Oh, thank you for having me, John. I really appreciate it. Hi, everyone. Great to be a part of today's show.
Yeah, absolutely. So, Mike, I guess talk to me about the market. What's happening right now? What are we expecting? As I said, people are sitting back on the sidelines, waiting, anticipating interest rates to come down.
I've seen this waiting behavior as you described it, and I believe that people are starting to get off the fence and start doing instead of waiting. And here's a couple of reasons why. Number one, the inventory, which was so tight last year, and really it was so competitive that people who were financing weren't winning. So there would be multiple offers and people with loans. That was pretty much the kiss of death, because why would a seller pick a finance deal with complications when someone's paying cash and they could just choose that buyer? So what's happened as rates went up last year is that people started backing off, and that caused the inventory to climb. So fast forward a year later, rates have come down a little since October, almost a full percent. So they were in the 7s and now they're in the low 6s. But people are still waiting. So we have a window of opportunity for buyers right now where the inventory is higher. You've got options and you have sellers that are wanting to make deals, and they will gladly look at any good financed option. And that's a huge opportunity, and you can negotiate. So you can go in, I'm sure you see this as well, that sellers are willing to give credits to help buyers do their deal. So it's been a major shift. Now, if rates go down, what do you think is going to happen to demand?
Obviously, back up again.
It's going to go up.
Yeah.
So if you're watching this and you've been thinking about buying a home and you're waiting, you need to stop waiting, because if rates go down, which they may, then everybody like you is going to get in. And that's going to create this competitive situation where the home prices will go back up. You won't have as much to pick from, especially if you're financing. Sellers will be back in control.
Right. Yeah, absolutely. Yeah. I've seen that. I've seen the inventory climbing some. If homes are priced correctly, they're still getting bought up.
That's
but unfortunately, I see people still pricing like it was January of 2022.
You're right.
And I'm starting to see homes on the market 80, 90, 100 days, which this time last year, it was 4 days and boop, gone. So
if you're lucky, sometimes 4 hours.
Yeah, right. Yeah, 16 offers in 4 hours, right?
Right.
So I know when the interest rates went up, we forced a lot of buyers, especially like first-time buyers, out of the market. So what are you seeing there?
You're right. That's dead on, and it's unsustainable. So you can only have so many price increases and rate increases before the housing market has to change. So we have this shift where people, if they want to sell, they have to lower their prices, because the pool of buyers has gotten smaller and smaller to the point where you do have that inventory sitting now. So I have noticed that with rates coming down, it's starting to be more affordable to buy a home. The difference between 6.5 and 7.5 can be pretty significant.
Yeah.
So affordability is slowly coming back. And the buyers out there that are still looking, again, this is an opportunity to capture the best possible deal that you can before the market changes again and rates go lower, which, if I had a crystal ball right now,
Yeah,
I would go back and change a few things in my life and a few houses that I bought in 2006. But if it worked right now, I would predict that rates will be in the fives by the end of the year.
Oh,
And
wow.
I'm paying very close attention to the May 10th inflation report. So this is a big deal. We expect that there's going to be a market moving drop in inflation on that date. And then as inflation comes down, rates come down, because what investors expect on their money goes up and down with, well, what does it cost for food and energy and housing and all of the market components in the inflation report. So, what do you think is going to happen if May 10th rates drop to 5.75?
Things get crazy.
It's going to make news.
Yep.
Everyone's going to know. They're going to go, all right, this is my time. Let's get in.
Yeah.
So from now until May 10th, you have this golden opportunity to write deals, to get in. So that's kind of my progression. I'm seeing way more applications, way more interest than I was even a month ago.
Right. So it seems everybody I talk to is under the impression that it's at least 20% down. And I know that's not right. So can you kind of touch on that?
You bet. Yeah, that's a great thing, is that Fannie Mae, Freddie Mac, Ginnie Mae, these are the three large aggregators of loans over the years, have really focused on making home purchase accessible for people who don't necessarily have a large down payment, or people in certain income brackets, or people of certain professions. So there are great products that you definitely don't have to put 20% down. And in some cases, you can put zero down. So that myth of having to have this huge chunk of money saved up, it's just not accurate. Fannie Mae and Freddie Mac have a couple of great programs called Home Ready and Home Possible, where you can put as little as 3% down with excellent rates and very cheap mortgage insurance, especially if you have good credit. FHA, that's been a program that's been around and it's backed by HUD. You only put 3.5% down. And if you were down south of us renting or owning a home where it was impacted by Hurricane Ian, we actually have a program that allows anybody that was renting or owning down there to get into a new home with zero down.
Oh, wow.
100%. It's called a disaster 203H loan. So if you're watching and you're south of us and you were impacted by Ian and the home that you were living in was damaged to the point where you couldn't live there, that's a great program. And then, of course, for our veterans, we have 100% VA product, which is probably my favorite loan. It's just awesome.
That's great. That's great.
So yeah, there's tons of options. We have all of those programs and more where people can kind of get in now. And I want to mention too, that because buyers can negotiate, especially with an awesome realtor like John, he can structure an offer and say, hey, I want you to pay for some of my buyer's closing costs. And not only does that help keep your cash to close lower, but you can use those funds to even create what's called a rate buy down. So let's just say the rate is 6.25. If you did a 2-1 buy down, the first year of owning that home, your rate would be 4.25. So you're taking that credit from the seller and utilizing it to create better cash flow for you. And it could be the perfect fit, especially if rates are going down. Well, now you have lower rates for the first year or two, and then you just roll into what we like to call buy now, refi later program.
Right.
And if you do a loan with us, we cover $2,000 of your closing costs on the refi. So
excellent.
We try to be strategic and plan and say, what do you got? Where are you going? What do you want to do? And then we figure out how to structure it in the best way possible.
Yeah, ironically, I did that back in 2018. Interest rates had gone over 5. I locked in at 5.25, waited a year,
Yeah,
refi, got back down to, I think we're at 3.22, something like that.
it's
So
awesome.
yeah. Hey, touch on mortgage insurance. I'm not
Sure.
absolutely sure. I thought they had changed it to that it stays with the life of the loan, but are you able to
Right.
get out of it at some point, or how is that working now?
Yeah, that's a great question. Well, there's different kinds of products that have mortgage insurance. Some of the government-backed loans do have MI, like FHA. USDA is a rural development program that has mortgage insurance as well. And for the most part, those government loans, the mortgage insurance sticks on that loan for the life of it. FHA, if you put at least 10% down, then the mortgage insurance only lasts 11 years. But, it's still pretty long term.
Yeah.
So the MI will never drop off, even if you gain equity in the home to the point where you have at least 20% equity. On the conventional side, different story. So if you don't put 20% down and have to have mortgage insurance as part of your monthly payment, as soon as you hit that magic number of having 20% equity, whether you're making your payment every month and through making those payments 4 or 5 years in, you hit that marker, then the mortgage insurance will automatically drop off. If we're in a healthy market and things appreciate 5, 6, 7%, then possibly in 2 years, or depending on how much you put down, you can actually request the cancellation of that mortgage insurance to your loan servicer. And most of the time, if you log in, they'll have all the directions on how to do that. So it is not permanent. You can get rid of it if you have enough equity, or you can refi. Rates drop into the 4s in a couple of years. Home values have gone up. It could be possible to, reevaluate your home with a new appraisal and only borrow 80% of that value when your mortgage insurance is gone.
Gotcha.
Plus you get a lower payment.
That's awesome. So with things the way they are right now, like what are you seeing coming up in the future other than hopefully being 5% at the end of the year? What's the word
Sure.
out there?
Yeah, I'd say that we've returned to normal.
Yeah.
We kind of had this pandemic fueled housing frenzy, and obviously with the Federal Reserve dumping money into the system, buying mortgages and making rates lower, we kind of had this hyper fueled buying spree, where people were like, I want to buy a second home. I want to buy, a primary, and it just seemed like money was so cheap that, for 2020, 2021, and a little bit of 2022, it was just, everybody was all in on housing. And then rates went up and things changed. And what we're seeing right now is probably more of just like a normal market where houses priced right will sell. If they're priced too high, they won't. People who are buying, if you're making a reasonable offer, you can win and negotiate. Yep. And if you're expecting housing prices to crash and go back to where they were in 2019, John will tell you, I'm going to tell you, that's not going to happen. We kind of had this up and now we're here and we've plateaued. I don't really see anything changing the Florida landscape because it's going to be 70 degrees this weekend, 80 degrees. It's winter.
Yeah.
We don't have state tax. We have a pretty forward-thinking administration here in the state. And you have a lot of freedom and flexibility here in Florida. And with 1,000 people moving here a day, you're not going to see any type of housing crash anytime soon. So accept things for where they're at. Be strategic about how you structure, the way you leverage or the way you finance. Know that owning a home 9.5 times out of 10 is going to be a greater wealth strategy than renting. So I think it's just accepting what we have now as the new normal. I looked at how many loans I had closed last year and compared it to the couple years before. And I'm like, oh, wow, the mortgage market and the real estate markets crashed. But then I looked at 2019 and realized I closed a few more than I did back in 2019. So we kind of have this dip, but we're still on this trajectory where Florida housing is going to pay off if you get in now.
Yeah, I was talking to some clients today, and I'm seeing actually the builders are increasing prices right now because their costs have gone up.
Sure.
Their labor costs has gone up. The cost to put an air conditioner or appliances in a house. Some builders are even not offering all the appliances like they used to do.
Yeah. Well, that's interesting. And I know that they're in a hurry to get rid of their inventory because they do want to get on with what you just mentioned. They want to get on with some normal pricing, but they have some straggler inventory that's kind of there. So again, a huge buying opportunity with John. He can get his hands on that available inventory where they're offering incentives. They're offering some money to help pay for your closing costs and potentially do a buy down. Sometimes the incentives are so good that it beats what I can do, but John will gladly forward along any documents and I will review them for free to make sure you're structuring things in the best way possible. And then I'm going to keep in touch with you when rates drop in a year or two and say, hey, I remember you got 6.3 or 6.5 from Pulte Mortgage. We can get you 499, and save you $500. So, look at what's out there right now and seize the opportunities that exist, because you're right.
Yep.
They want the price to be higher, but they got to get rid of all the ones they need to sell.
Yep.
For the next couple months.
Yeah, I always tell people that. I said, talk to the builder's lender, see what they're offering, what they're giving you. They're not giving you anything for free. They're going to make it up somewhere, but then let Mike compare and he'll be honest with you and tell you, you know what, take their deal. It's a better deal.
You're right.
Or no, it's not. He'll tell you the truth. It's not a better deal. So I always recommend that they compare just to make sure, because builders, they say they're giving you these incentives, but they're going to make it up on the back end somewhere.
Yeah. They make money when they sell the loan and when they write the title policy. And obviously when they build the house, they have margins in there. But you want somebody that's going to represent you, like John. He's going to be your advocate. So don't ever go to Zillow and choose the realtor, that's got the listing. Always talk to John first. Don't just walk in a model home. Talk to John first, because you need an advocate in the system that's going to negotiate for you. And, same with lending. These people that work for the builder's lender, well, they work for who? The builder. They want to write your loan, but you need an advocate that can help you structure things that meets your goals. And so it's really important to have the right team. If you decide to get off the fence, get in and seize this huge opportunity in the housing market right now.
Yeah. Yeah. Well, we work with a ton of baby boomers. They're all heading this way. And,
That's right.
Some of them are selling the house up there. Some of them, we had a closing this morning, and they're just going to be snowbirds. They bought a house in Webb, going to be snowbirds, and they were cash, but ton of them coming down. So, Mike,
if anybody's in Buffalo, I'm sure they could eventually dig themselves out and make it to Florida. But I don't think the Florida Chamber of Commerce could ask for a better winter so far.
Yeah, it's amazing.
Drive traffic this way, because it has been cold and snowy and epic.
Yeah. Yeah, buddy. Well, Mike, if people want to get a hold of you, ask questions, or what's the best thing for them to do?
Yeah, well, I'll have you pass along my information, but I do have a website. It's appwithmike.com. That's my landing page, and you'll see tons of great information on the mortgage industry, the process. There will be a link on there where you can contact me. There's a link on there to fill out the free application so you can put your financials together and we can come up with a game plan on how to best structure a future loan. You can call me at 941-213-4428. That's my main office line, rings here. I have a team in the event that I'm shooting a video or helping another client. So, we're all hands on deck. We definitely want to make sure we move at the pace that our clients want us to move. If you need a pre-qual in a day, we can make that happen. If you're like, hey, I want to do something this summer, no problem. So we've got a lot of different ways to reach us, but we're definitely here. We're ready. We know this is a huge opportunity this year, and we feel that sense of urgency.
Yeah. One thing I didn't ask you, a lot of times when these baby boomers are coming down, Mike, and they got a fistful of cash,
Sure.
I tell them, look into a 15-year mortgage, and, there's no prepayment penalty.
Right.
And hold on to some of your cash case. Do you want to add a pool? Do you want to do something to the house?
Good point.
That cash sitting there. What are the current rates on like 15-year product?
Yeah, it's surprising. The investment community right now, at least the products we have access to at Cross Country, they believe rates are going to go lower. So what that means is that if they write loans and have a servicing portfolio that's kicking off income, they don't want all these people paying loans off. So they're not pricing the 15-year fixed as aggressively as they used to. In fact, you might have a 30-year fixed rate at 6.25 and the 15 may only be 6. So the arbitrage, the spread there isn't as compelling. You could always double pay your payments and make it a 15-year loan. I'm seeing the 20 though pricing better, where it might be 5.8. So you have a little bit better spread with the 20. Some of the ARM loan pricing, not great either. Because they don't want a bunch of people paying the loans off and then their portfolio isn't producing as much.
Right.
When you get over 726.2, that's the cutoff for the conventional loan limit. Then things change a little bit more because I do believe, though, most of the jumbo loan investors are being more aggressive with their ARM money. So I'm seeing ARM rates in the low 5s. And an ARM is an adjustable rate mortgage. So it's a fixed period for 7 to 10 years where the rate stays the same and then it can change. So there's pockets where you can find lower rates.
So people have the ability, most people are under the impression that a mortgage is 30 years, it's 30 years, it's 30, but they have the ability to come in and say, yeah, I'd like to get 20 year or
Sure,
15 year or 22 year or whatever.
That's right. Yeah, the common AM schedules are 15, 20, 25, and 30. And you kind of see that nice improvement in the rate spread once you hit 20 years or less. But again, my 15-year rates used to be 3/4 lower.
Right.
And now I'm not seeing that. Now that can change as the market stabilizes and there's less likelihood of having this refi wave on the horizon.
Right.
But for now, our job is to kind of evaluate all of the options out there. And, but yeah, you can still leverage with fairly cheap money. For anybody that's been alive longer than 35, 40 years, that in the 80s and 90s rates were in the teens, and then high double digits and then dipped into the 8-9 range. So historically still really cheap money. And it's actually cheaper than equity line money right now. Because equity lines are based on prime and that's at 7.5. So 6 sounds pretty good.
Yeah. Yeah. Well, when I talk to renters, I'm like, so what's the interest rate on your rent? And they always look at me like, what are you talking about? I'm like, the interest rate on your rent is 100%. Yeah.
Right.
So, because you're getting nothing out of it. So 6.25
Yeah,
is a lot better than 100%. So
you got
yeah,
it.
well, that's awesome.
There's
Well, Mike, I appreciate you taking the time.
You're welcome.
I love referring people over to you because I know they're going to be very well taken care of, get all their questions answered, and you give them an honest answer, which is very, very,
Right.
very important to me.
Right. There's nothing more important for me than for people to know before they owe. I want you to know what your payment's going to be, what your options are, how much cash to close you need, what's the game plan that's going to fit your lifestyle, at least for the next 5 to 7 years. And we try to find the perfect match. But again, I appreciate it.
What do you tell them? Just last question here. What do you tell them to start gathering for you to qualify?
Well, I like to tell people I'm going to collect the least amount that's going to get the greatest result. But in some people's cases, it's a lot. If you're self-employed and you file business tax returns, then I'm going to dive right into those right out of the start gate to make sure that we're not just pre-qualifying you based on your self-reported information. If you have a good CPA, probably write a bunch of stuff off. So we want to take a look at that. If maybe you're retired and we're going to use retirement income, then we'll, gather financial statements. If you have a W-2 position, then sometimes all we need is 30 days of pay stubs and a W-2. So, we'll craft your list of things that we need from you based on what you report to us, both on the phone and in the application.
Yeah. Yeah. And a pre-qual letter, give me the definition of that. Because when I tell people you need to go, before we go look at houses, let's get pre-qualified.
Sure. Yeah, absolutely. That's a really important. Some people call it a pre-approval letter, pre-qualification. I don't really get hung up on the language difference. But for us, we want to see your credit report. We want to see all of your financials, what you make, what you do, how much you have. We want to know the backstory. So in the credit report, it's going to show any prior issues, bankruptcies, foreclosures, other properties you own. So we can get the complete picture and then run your data through an underwriting system called Desktop Underwriter. Once we do that, it will kick out an approval and say, hey, you can definitely do this loan based on these parameters. And that's when we know you're truly pre-approved. And then we will craft a letter to match any future offer and say, hey, you can buy this $500,000 home with 5% down. Here are the numbers. Go get them.
Yeah.
And, we'll be strategic with John. If you want to go in and offer 490, we don't want to kick out a letter that says you could, buy $1 million house, because, a seller might go, oh, well, I'm going to hold out for this guy.
Yeah.
So, we try to customize it to whatever you need at the time. But
Awesome.
That's the golden ticket right now. Because
I'm straight up with people. I'm like, there's no point in us going to look at houses because I don't know if you can afford 300 or $1 million.
Right.
I don't know. And we certainly want to have you looking at homes because I'm good. I'm going to find the home that you want, but we got to have that letter because I'm going to write an offer. And that's the first thing they're going to ask for.
Absolutely.
So, awesome. All right, Mike. Well, again, I appreciate your time. Thank you so much.
So welcome, John.
And, we'll get some people over to you soon.
Sounds great. Hey, thanks for watching and thanks for having me on, and look forward to coming back sometime and giving you guys a market update.
Awesome. Thank you, Mike.
All right, John. Take care.
Are you sure?